Educational content only, not financial advice. Every legitimate trade begins in a state of clinical detachment. You sit at your desk, analyze a setup, and map out the parameters of your plan. This chart shows the mechanics of predefined risk. Before entering the market, professionals locate the exact price where their trade idea is mathematically invalidated. They place a rigid boundary, a stop-loss, to ensure capital is protected if the market disagrees with their thesis. During this phase, your emotional state is calm. You accept the math. You understand that hitting a stop-loss is not a personal failure. It is simply a statistical reality of operating in the markets. In this window, decisions are driven by logic. You are detached from the trade's outcome. Then, the market opens. As live price action ticks downward, inching closer to your established stop, the sterile planning phase disappears. Internal tension builds with every downward tick. The statistical acceptance you felt 5 minutes ago evaporates, replaced by a sudden, intense urge to rationalize the market structure and give the trade a little more room to breathe. And then the system breaks. You reach out, click the mouse, and drag your stop-loss down to a lower price point. You logically know that moving a stop destroys your risk control. You know it ruins your consistency. So why do you actively sabotage your own plan the exact moment the market applies pressure? If we freeze the timeline at the millisecond you drag that mouse, we can strip away the market context and look at your internal state. Moving that line is rarely a strategic calculation based on new information. It is driven by a primitive mechanism, loss avoidance. This diagram shows how your biology interprets the market. The human brain does not easily distinguish between abstract financial danger and literal survival. It processes a pending loss on a screen as an immediate physical threat, triggering a rapid wave of alarm signals across your nervous system. This biological alarm system floods your body with intense emotional discomfort. It feels awful, and your biology demands immediate physiological relief from that pressure. Feeling cornered by the approaching stop, your brain bypasses logical strategy entirely. It acts to neutralize the emotional pain using the fastest tool available, moving the boundary away. This diagram illustrates the mechanics of that false relief. Moving the stop-loss does not fix a bad trade. The pending red block of loss is simply pushed further into the future. You have delayed the realization of the loss, winding up a tightly coiled tension spring in the process. In the short term, you feel an immediate drop in anxiety because the trade has more space. But this momentary comfort masks the extreme danger building up on your account balance. The clinical reality is that a severe rule breach has just been committed. The parameters that protected your capital have been abandoned. In the span of a single mouse drag, you transition from a professional executing a disciplined statistical system to a gambler relying on blind hope. Dragging a stop away from a loss is an act of self-soothing. It is a subconscious defense mechanism designed to flee a negative feeling rather than manage a market position. The true danger of this mechanism reveals itself when this behavioral loop is repeated across dozens of trades. This chart displays the long-term mathematical result. A sequence of calculated, predefined risks should result in small negative columns, paper cuts a trading system can easily absorb. Unchecked emotional loss avoidance turns those paper cuts into a single, massive downward wound that destroys the account. This specific inability to tolerate discomfort in the moment is the primary reason retail day traders and futures traders fail to achieve long-term consistency. Professional survival requires you to recognize and neutralize this destructive reflex before your hand touches the mouse. To fix this, you must forcefully separate your planned strategic stop adjustments from your emotional stop movements. A legitimate, planned adjustment is written into your system before the session begins. Trailing a stop behind a profitable trend or moving to break even based strictly on predetermined market structure rules is strategy. An emotional adjustment happens on the fly. You are moving the stop simply because the price is getting uncomfortably close and your anxiety is rising. So the next time you reach out to give a losing trade more room, pause and ask yourself, when you move a stop, are you following a rule or avoiding a feeling?